Hello again. Today we'll be discussing about the financial statements that in my last lecture I stopped at the accounting equation and the rules for debits and credits, and talked about the double entry accounting system. And as I communicated to you guys in my last lecture, that today in my next lecture, which is today, I'll talk about financial statements and also tell you the structure and format of the financial statements. So let's get started and talk about the different types of financial statements. So you have three types of financial statements. Number one is your income statement. Then, number two is your statement of owner's equity. Or also known as the owner's equity or equity statement. And then you have number three, which is the most important. All of the three are important, but I personally like the balance sheet a lot because it gives you a snapshot of all your financial performance over the year. Income statement, it goes in the same exact order. Number one, first of all, you make an income statement, then you do a statement of owner's equity, and then finally you do a balance sheet. And you'll see why it's in that exact order, or it's done like that. So let's start on the income statement first. So you will write the company's name. We're doing a income statement for XYZ company. This is who. What is your income statement? And then finally, you have the third, which is who, what, and when. So this is for the month ended December 31st, 2017. So this is the format of when you start an income statement. You always write who, what, and when. So the three things: the company, what type of statement, and the date. Most important, one of the most important aspects is to mention that this is for the month ended December 31st, 2017. You start off with the revenue for income statement. Revenue has your consulting revenue, for example, will be revenue account. If you do the T account, you will see revenue goes up on the right hand side, which is the credit side. So you will write, for example, 1500 on you'll indent it towards the far right. Then you had rental income as well, which is also your revenue, which was $1,000, for example. So your total revenue came out to $2,500. This is your total revenue for the month ended December 31st, 2017. Now we go into the second part of the statement, which is your expenses. Your expenses are outflow or disbursement of money, as you know. So you had salaries expense, and when you do the T account, you can look at expenses. Your expenses go up on the left hand side, they increase, and they go down on the right hand side, they decrease. That's why you will write expenses, you won't indent it, and you will write expenses on without the indentation. So your salaries expense was 1,000. Your rent expense, you had a rent that you paid was 500. You were living on sharing, for example, and you paid 500 rent, and you had another expense. You had utilities expense that you had to pay for 500. So you have 2,000, and finally you had another expense. You had an expense for your car, your gasoline. You spent gas. You were driving, and you had a gasoline expense. So gasoline expense would be 500 as well. So that came out to 2,500. Those were your total expenses. So your total revenue was, you always place a double line to make sure that your revenue is equals to your expenses. Your total revenue was 2,500. Your total expenses were also $2,500. So what was your net income? Your net income was 0, because your revenue match your expenses. So your net income was 0. You balanced out. You neither made money nor you lost money. So you ended up with a balance of 0, where you neither had to owe money or neither you had to pay money, because you ended up at a net income of 0, which is good. You break even. In other words, this is your break even. You break even here with your net income. You didn't make money. You didn't lose money. The other second part of these is where we talk about the statement of owner's equity. We'll do the same, and we will say XYZ company. We have statement of owner's equity. And we have what? We have the who, what, when. For the month ended, it would be the same for the owner's equity. It won't change. December 31st, 2017. So this is what we start with. For owner's equity, you will always take into account the first and foremost, which you will always take into account, is your retained earnings. So your retained earnings are those earnings which are carrying forward from the previous year, from the last year. So from last year, your retained earnings were actually we'll use December 1st. Trying to find the eraser. So December 1st, 2017, beginning of the year, your retained earnings were 0. Let me just try to put it a little bit here. So next thing you add your net income. Was there any net income? This is where you reference it to the income statement. Your net income was 0. You break even. You didn't have any net income. So your retained earnings, you didn't have any retained earnings. You didn't have any net income. You paid dividends. I would go back for a second and I would change your retained earnings and I will, instead of 0, I will say we had $2,000 of retained earnings. Just to give you an idea of how this is done, and to clarify on the concept, I changed it from 0 to 2,000. I said, okay, we have 2,000 of retained earnings at the beginning of the year. But going back to our net income, we had a 0 net income, or we had no net income at all. Our dividends we paid out. Dividends are always paid out. So when you make the T account for dividends, and you do the T account, your dividends, what happens to your dividends is they are increasing, as you will see that your dividends, the T account, you increase on the left-hand side and they decrease on the right-hand side. So they go up and they go down on the right-hand side. So you pay out your dividends. Dividends are paid out. You paid $1,000 in dividends, and what happens next is that you have your retained earnings, which is retained earnings as of December 31st, 2017. This was December 1st, beginning of the year. This is end of the year. You had $1,000, which is your net retained earnings. Also, just to give, you will put the dollar sign here as well. You had $0. So your retained earnings as of this year is $1,000 based on this. Now the last statement we'll make is the balance sheet, and this is one of my favorite financial statements, because it gives you the snapshot of a firm's financial picture, or snapshot of it at the end of the year. How much assets do you have? How much liabilities? What's your equity? And it gives you an idea about the financial performance of the company, which is very important to know. So we will do the balance sheet for XYZ company, and we will do the same. The only thing different here for balance sheet is that you would write the date, which is December 31st, 2017. You will write the date for the balance sheet, which is basically, you will not write for the month ended as you did in the income statement and owner's equity statement, but you would write the date as it's by itself, that this is December 31st, 2017. This is the balance sheet on that specific day. So you have your assets. First, you had cash. You had 500. This is a dollar sign. You had account receivable. You had 1,000. You had prepaid rent, 500. You had supplies, 500. You had let's say we also had prepaid advertising, which is another asset for 500. So 15, 2,000, 2,500, 3,000. So 3,000 will be your total assets. This is the asset side. Now we move on to the liability side. You had liabilities. You had, let's say, accounts payable for $1,000, and you had notes payable for $500. So this is 1,500, which is your total liabilities. Your total liabilities are $1,500. And then finally, we move on to the last section, which is your owner's equity. And owner's equity, you will write out the common stock and your retained earnings. So your common stock was, for example, was 500. We are making it up. It was 500. And your retained earnings, actually we have, yeah, perfect. Your retained earnings that we will carry forward from here to here were $1,000. So this comes out to $1,500, and you add the total liabilities, $1,500, you will get the $3,000, which is your total liabilities and owner's equity, which basically gives you the idea here, as you can see, that your left-hand side assets, because the accounting equation is assets is equals to liabilities plus owner's equity. Assets were how much? Were 3,000 right here, and your liabilities were 1,500 plus your owner's equity was 1,500. So 3,000 is equals to 3,000, which proves that this equation, in the form of equation, that this statement is correct. It gives you the whole breakdown of the structure and breakdown of your balance sheet, which I've explained in a lot of detail, just to give you an idea that how the financial statements, that process works. That you have your income statement, all this went to when you had your break even, which was net income. Net income was 0, which was right here. So this amount went right here to your income statement. So from your income statement, that amount went to your owner's equity, and from the owner's equity, the retained earnings went to the balance sheet, equity side. So that's why this is in this order. You have the income statement first, then you have the owner's equity, owner's equity, and then you have the balance sheet. I hope this clarifies a lot of concepts on the financial statements. I have tried to break it down in the most simplest terms as possible while giving you a lot of detail on how the financial statement works. If you watch this video, I'm sure you will understand these three statements. These three statements are the backbone of accounting. In the financial on the financial statement side, you got to know this information and understand how this works. You cannot understand this unless you understand the accounting equation and you understand the debits and credits, how the debits and credits work. Once you understand you can understand the financial statement because it builds on that. Have a great day. Hope you enjoy this video. Thank you very much for watching.